Often wealth gets passed from one generation to another through something called a trust. But what does this mean? What exactly is a trust after all? Well, a trust is perhaps best understood by imagining the three parties that are involved. So whenever you're dealing with a trust, you have first and foremost a donor. This is sometimes called a settlor or a grantor, but this is the person who sets the whole thing up, who decides that they want to transfer a certain amount of property, maybe it's a house or investments or shares in a company, to somebody else for a specific purpose. So in our example, we have Liz here, and she's a former executive of a Fortune 500 company who decides she wants to transfer a certain portion of her investment portfolio to her 8-year-old daughter, Megan, maybe to help her pay for a house someday. So imagine Liz takes these investments and places them in a separate account or a trust. Now, there are many different types of trust, but for our purposes, let's say that this is an irrevocable trust, meaning Liz has to set the rules for the trust at the very beginning. That is, when Megan is to get the money, in what amounts, and for what purposes. And see, once she puts these assets in the trust, she no longer controls them. So she thinks about it for a long time and consults with a legacy planner and ultimately decides that all of these investments will go to Megan, but not until she's 28. However, in the meantime, some of the money, she says, can be used for certain expenses that might arise for Megan, and she specifies exactly what these things are in the terms of the trust. Now see, Megan, because she's the one who's ultimately going to be receiving the benefits of the trust, is called the beneficiary. But remember, she's only 8 years old. Liz needs somebody to be able to manage these investments and to see that her rules are enforced and respected and carried out. And so that role belongs to the third person in the trust triangle, and that is the trustee. The trustee is the person or organization that the donor entrusts to carry out their wishes for the trust. So in this case, Liz has nominated a financial professional that she's worked with for many years to be the trustee. So let's say time passes, and Megan's not quite 28 yet. Maybe she's 23, and she learns that she has this trust. And so she wants some of the money for the trust to maybe pay for something. Maybe it's a car or medical school tuition. Well, if that's the case, then she would have to then ask the trustee for a distribution from the trust, at which point the trustee would have to go back to the terms that Liz has initially set out and try to determine whether or not that allows for a distribution to be made. So the answer in this case could either be yes or no. But see, this brings up a very important question, which is, why pass wealth using a trust as opposed to just giving it to someone directly? Well, there are four main benefits. The first is it allows donors to select someone to make sure that their wishes are enforced and carried out. And it also allows them to find someone who will manage the investments and to ensure that those distributions are made to the beneficiary. And so this way they can have confidence that the wealth is being managed wisely. Now, they often choose to appoint someone with expertise in these matters, so a professional in investment management or legacy planning to do this. The second benefit is that in many cases it allows the donor and the beneficiary to minimize taxes. Now, it varies from trust to trust, but often trusts give them the opportunity to pass on wealth at a steep tax discount or tax-free. The third benefit of a trust is that when it comes to wealth, it allows you to specify the who, the when, and the how. So let's say you wanted your wealth only to go to a particular charity in the future, or only to cover a future down payment for a family member 30 years out, or maybe to go to somebody with absolutely no strings attached. Well, you could do all these things through trusts. Trusts give you that flexibility. And the fourth benefit is that in the case that a donor passes away, having the wealth in a trust allows them and their families to avoid the probate process. This is the sometimes expensive and ugly process of having the courts sort out who gets what when somebody passes away. But see, before going further, it's important to emphasize one important thing, and that is that trusts vary widely. You can't paint them all with one broad brush. So donors have a lot of flexibility in the types of trusts they can create. And that means if they want to, they can create trusts that have long terms or short terms. They can create trusts that have very specific purposes or unspecific ones. They can create trusts that have single beneficiaries or multiple beneficiaries. They can create trusts that have a host of different tax benefits. The point is, a trust gives you the ability to accomplish a wide variety of goals. But see, trusts can be very complex and thorny. And so for that reason, it's important to understand exactly what you're getting into before setting one up. And this, of course, is where a legal advisor or legacy planner fits in. But see, after you've taken the steps to establish a trust and know what you're getting into, the bottom line remains that trusts are a basic planning tool that give you the ability to transfer wealth a variety of ways and to accomplish a wide variety of goals.